Hey, if you've ever ordered a late night burger or gotten groceries delivered in like 10 minutes flat, you are actually part of a multi-billion-dollar shift that's happening right now. Welcome to this explainer, where we're diving into the fascinating turnaround of India's new age tech stocks and breaking down the massive upcoming Swiggy IPO. For years, the story of Indian tech startups was totally defined by aggressive expansion, sky-high valuations, and, frankly, massive cash burns. But that narrative is changing, and it's changing fast. We're witnessing a really pivotal moment where former cash-burning engines are finally starting to prove their financial viability. So today, we're going to explore this shift, look at the winners and losers, and unpack exactly what this all means for one of the most anticipated market debuts of the year. So here's the roadmap for this explainer. We'll kick things off with the tech stock rebound and the shift to profitability. Then we'll check out the struggling giants. And finally, we'll jump right into the ring with Swiggy, breaking down their IPO financials before wrapping up with the risks and opportunities ahead. All right, Section 1, the tech stock rebound. Let's start with a really telling number, 1.4 crore rupees. That is the consolidated profit reported by co-working space provider Office in the fourth quarter of the 2024 financial year. And here's the kicker, it was their very first financial result since listing on the market. They actually turned a profit and boom, their stock jumped 22% in just a single month following that announcement. It's basically a perfect snapshot of what investors are rewarding these days, actual, cold, hard profit. And this wasn't just a one-off thing. Caught up in a broader market rally, 15 out of 23 new age tech stocks saw massive gains in just the third week of June alone. I mean, look at these numbers. MapMyIndia surged nearly 20% after some strong analyst ratings. PB Fintech was up 18%, and Zomato pulled in a solid 9% gain, with Nykaa right on its heels at almost 9% too. The market is clearly finding renewed faith in these digital-first businesses, as long as they have a solid foundation, of course. Moving on to Section 2, the shift to profitability. Take PB Fintech, the parent company behind Policy Bazaar and Pisa Bazaar. They pulled off an absolutely remarkable turnaround. After years, and I mean years of heavy losses, they posted a profit after tax of 64 crore rupees for the fiscal year. That is a massive milestone in the startup world. Hitting actual profitability is a huge deal. Their revenue grew by 34% and their core online marketplaces did even better. They proved that, hey, a digital-first insurance and lending model can be a highly profitable enterprise when you finally buckle down on operational efficiency. Then there's Zomato. If you break down their revenue engines, food delivery still dominates at 63% of their gross order value. But check out that 24% slice. That is quick commerce, driven by Blinkit, and it's rapidly becoming a highly attractive growth segment for them. In fact, quick commerce grew over 100% year over year in 2023. Zomato isn't just delivering your dinner anymore, they are aggressively diversifying the whole business. So what does this all mean for the bottom line? Well, Zomato's 56% revenue growth translated into a historic 324 crore rupee profit in FY24. That's just staggering. It proves that ferrying around our dinners and last-minute grocery runs can actually be an incredibly lucrative business once you hit that massive scale. It's a huge signal of incredible operational execution in these underpenetrated markets. Okay, let's pivot to Section 3, the struggling giants. Now, it's not all sunshine and rainbows. We're seeing a really stark contrast right now between companies that are thriving on their first-mover advantages and those completely paralyzed by regulatory hurdles. On one hand, you have MapMyIndia, a digital mapping leader whose open order book grew by an incredible 49%, leading to a 35% jump in profit. But then, on the flip side, you have the fintech pioneer Paytm, which is really struggling to navigate some intense regulatory turbulence. It's honestly pretty sobering to see how fast things can turn. Early in 2024, the Reserve Bank of India slapped severe restrictions on Paytm Payments Bank because of persistent non-compliance. And the fallout? Immense. Their stock plunged nearly 50% in just a few months. We're talking ongoing layoffs, employee complaints about unlawful termination, and major global investors offloading hundreds of crores worth of shares. Paytm is basically serving as a vital cautionary tale right now for the whole fintech industry. If you ignore regulatory compliance, it can literally decimate your market value overnight. Which brings us to Section 4, Swiggy enters the ring. So, is Swiggy actually ready to deliver returns to public investors? That is the multi-billion-dollar question. As Swiggy gears up to raise massive capital from the public, we really have to ask, can they replicate Zomato's path to profitability? Or are they going to succumb to the intense, relentless pressure of public market scrutiny? To really grasp this market debut, we need to look at the deal structure. Swiggy's IPO is for a staggering 11,327 crore rupees. But here is the crucial detail. Out of this massive issue, the vast majority, about 6,827 crores, is actually an offer for sale, meaning existing investors and promoters are simply cashing out. Only 4,499 crores is a fresh issue of new capital that will actually hit the company's bank account to fund their future growth. All right, let's open the books in Section 5, Swiggy IPO Financials. These financial numbers tell a fascinating story of rapid growth, but paired with some pretty persistent bleeding. Swiggy's total income has nearly doubled since 2022, jumping from about 6,119 crore to over 11,634 crore in FY24. But they are still deeply in the red. Yes, they did narrow their losses from the previous year, but they still posted a massive 2,350 crore rupee loss in FY24. That's a deep hole to dig out of. So where exactly is that 4,500 crore of fresh capital gonna go? Well, a massive chunk, almost 1,179 crore rupees, is set aside just for expanding their Instamart dark store network through their subsidiary Scootsy. So next time you get an order delivered in 10 minutes, remember, this infrastructure is where billions are being spent to fight off Blinkit and Zepto. Another 1,115 crore is going straight into brand marketing and business promotion. They are aggressively, and I mean aggressively, prioritizing the expansion of their quick commerce footprint. And this sets up the ultimate dilemma for the market. When you compare the two giants side by side, you just can't ignore the bottom line. Investors are being forced to weigh Swiggy's clear operational growth and expanding ecosystem against Zomato's proven ability to finally turn a healthy profit. Now, Swiggy's management is confident they'll turn profitable in the coming years, but let's be real. Public investors have notoriously less patience than private venture capitalists. Which leads us right into our final part, Section 6, Risks and Opportunities. The reality here? Investing in this space is absolutely not for the faint of heart. You have to be okay with a roller coaster volatility because tech stocks are heavily driven by market sentiment and macroeconomic factors like inflation. Plus, as we vividly saw with Paytm, there is this ever-present threat of intense regulatory scrutiny. In a sector that is literally defined by disruption, relentless competitive pressure means these companies have to constantly innovate, or they'll die trying. But on the flip side, the upside potential is absolutely electric. Quick commerce is radically changing consumer habits in India right before our very eyes. Companies are finally charting clear paths to positive EBITDA, like Nykaa Fashion aiming for profitability by FY26. And outside of e-commerce, companies like NetWeb Technologies are riding this massive global wave of AI and data center investments. The diversification and market disruption we're seeing represents some monumental growth potential for the future. So, this brings us to a final thought. When we look at Zomato's celebrated success in finally getting into the black and Swiggy's impending high-stakes test on the public markets, we leave you to ponder this. Will the market ever again tolerate tech giants that can't prove a clear, undeniable path to profitability? Or has the new age of tech finally been forced to grow up? Thanks so much for joining us on this explainer, and remember to keep your eyes on the numbers.